Is your mortgage tax deductible? Most Canadians pay thousands a year in mortgage interest and get nothing back from the CRA. Not because it can't be tax deductible, it's because their mortgage was never structured properly. In this video, I'm going to show you how Canadians legally turn mortgage debt into tax deductible debt, why cash damming works so well, and who this strategy is actually for. Let's go. Now, before we go any further, I need to be very clear about something. This is not a CRA loophole. This is not a hack. And this is definitely not about committing CRA tax fraud. Everything you're about to hear is based on how the CRA already treats borrowed money. They don't give a shit what the loan is called. They care what the money is used for. Once you understand that one simple rule, your entire mortgage starts to look very, very different. And that's where cash damming comes in. Most Canadians are told one simple thing about their mortgage: pay it down as fast as you can at all costs. And while that advice isn't wrong, it's not complete, because what nobody explains is that there are two kinds of debt in Canada. There's bad debt, which is non-deductible debt, and good debt, tax-deductible debt. Your personal mortgage falls into the first category. Investment and business debt fall into the second. So every month when you make a mortgage payment, you're paying interest with after-tax dollars, and the CRA gives you absolutely no credit for it. That's the default system, and default systems don't build wealth. Here's the most important rule you need to understand. Interest deductibility follows the use of the money, not the name on the loan. The CRA doesn't care if it's a mortgage, a line of credit, or a loan. They care where that borrowed money goes and what it's used for. If the borrowed money is used to earn income, the interest may be tax deductible. That's it. That's the rule. And just to be clear, tax deductible does not mean tax-free. It means you're reducing the after-tax cost of the interest, not eliminating it completely. So the real question becomes, how do we legally change the use of the money? And how do we do that without changing lifestyle or cash flow? Let me show you this visually, because this is where it really clicks. Normally, rental income flows straight to rental expenses. That works, but it's tax inefficient. With cash damming, we flip the order. Rental income flows to the personal mortgage first, then we borrow that same amount to pay the rental expenses. We're not changing the money. We're changing the direction or the flow of the money. Same dollars, different flow, way different tax results. There are a few strategies that do this. A debt swap, which replaces non-deductible debt with deductible debt without increasing your overall borrowing. And cash damming, which is what we're focusing on today. If this is already making you rethink how your mortgage is set up, pause for a second, because this strategy, it only works when it's structured correctly. If you want to know whether cash damming even makes sense for your mortgage and your rental setup, that's exactly what I help homeowners figure out. You can check out the link below whenever you have time or when you're ready, and you can book a call with me. Cash damming, it's a cash flow redirection strategy. You don't earn more money, you don't spend more money, you don't change your lifestyle, you just simply change where your money flows first. That's the beauty of this. Normally, rental income pays rental expenses. With cash damming, rental income is redirected to pay down your personal mortgage first, the non-tax deductible debt. Then borrowed money is used to pay the rental expenses instead. The same properties, the same expenses, the same cash flow, but now the borrowed money is being used to earn income, and that changes the tax treatment of the interest. This only works if there's a clean paper trail, separate accounts, clear tracking, and a direct link between borrowed money and income producing expenses. Let's make this simple. Say you have a condo rented with $3,000 a month in expenses. So let's just call it cash flow neutral. The rent's $3K, the expenses are $3K. This includes the mortgage payment, strata, property taxes, and insurance. Normally, the rent's gonna cover these expenses, and that's the end of it. You're happy. But with cash damming, that rent goes straight onto your personal mortgage, attacking that non-deductible expense. You then borrow $3,000 from your home equity line of credit to pay the rental expenses. Nothing's changed operationally, but the interest on that borrowed money is now tied to an income producing asset. Same dollars, different direction, different tax result. This is where people often get confused. The Smith maneuver uses your personal income to gradually convert mortgage debt into investment debt. It's powerful, but but it's slower. It often involves market investing, which I'm not talking about today. Cash damming uses rental income instead. It works faster, it's cleaner on paper, and it's often easier for the CRA to follow when structured properly. Note, structured properly. This is why you need a mortgage broker who can handle the structure setup and guide you along the way. The simplest way to remember this is that the Smith maneuver converts debt over time. Cash damming redirects cash flow immediately. Cash damming accelerates your personal mortgage paydown without increasing your payments. There's no change to lifestyle here. You're not sacrificing going out for dinner with the wife and kids and making that money spent onto the mortgage. You're just going to redirect the flow. It increases your tax deductible debt while reducing your non-deductible debt. It improves long-term cash flow because deductible interest costs less after tax, and it creates flexibility. You're no longer just paying debt, you're managing the debt strategically. At this point, you're probably starting to see why structure matters more than rate. But this is also where bad advice can create problems and get you in trouble. Where people get into trouble is mixing the accounts, using the line of credit for personal spending, or having the wrong mortgage structure from the get-go that doesn't support the strategy properly. If you're thinking about using cash damming, you need the right mortgage structure and you definitely need the right guidance. If you want help figuring out whether this fits your situation, that's what the link below is for. This is the part that makes people uncomfortable, a growing line of credit. We have to address the elephant in the room. Most homeowners panic when they see that line of credit balance increasing every month, but context matters. If your non-deductible mortgage is shrinking and your deductible debt is growing, you're not moving backwards. You're just changing the type of debt that you're holding. This only works if borrowed money is used correctly. No lifestyle spending, no mixing accounts. Structure and discipline matter here. And again, this is why you want to work with me, because I'm going to handle all this for you behind the scenes. Cash damming, it's not for everyone. It works well for homeowners who either own a standalone rental property or they have a basement suite in their house that's rented out. It works best with people who have stable income and a long-term mindset. It's usually not a fit for people without rental income. It's not for people living paycheck to paycheck who are stressed, and it's not a fit for anyone uncomfortable with leverage or structure. I promise you, my friends, this is not a TikTok strategy. This is long-term wealth strategy. For cash damming to work properly, 3 things must be right. You need the right mortgage structure, you need the right cash flow strategy, and you need the right mortgage professional advising you behind the scenes. A bad structure turns a good strategy into a mess. This is where strategy is going to matter more than rate every single time. For a lot of families, this isn't about being clever. It's about getting out of the endless cycle of paying interest and getting nowhere with the CRA. Most Canadians are told to focus on interest rates. Wealthy Canadians focus on structure. If you're already paying interest anyway, the real question is not how fast you eliminate your debt. The real question is whether your debt is working against you or for you. If you want to know whether cash damming fits your situation, that's exactly what I help homeowners figure out. Links are below, I've said it before. And when you're done with this video, check out last week's episode where I break down how bad the 2025 real estate market was in Vancouver.